Welcome to Illuminati Silver. We tell you the truth about silver. Today is Sunday, the 7th of February 2021, and we're looking at two comments or announcements made this weekend. One by European Central Bank President Christine Lagarde, and the other by US Treasury Secretary Janet Yellen. Both pointing to much greater stimulus ahead. And we take a brief look at what this could mean for the dollar and precious metal prices moving forward. So let's take that look. Firstly, just a quick shout out to the video we published earlier today, Bitcoin versus Gold and Silver episode 10, Gold and Silver down, Bitcoin rises over $40,000. And of course our weekly update published yesterday entitled Gold and Silver Weekly Update, weekend in the 5th of February. And we've placed links to both of these in the description box below. Now, one of the key questions economists have been asking since the Biden's presidency has been, how far will the president go in inflating the economy? And how likely is he to succeed? With the Democrats having control over the presidency and both houses of Congress, one would expect, if push came to shove, as we say in the UK, he should get almost all that he asks for. Though, of course, we accept this cannot be guaranteed 100%, especially with the majority in the Senate, all coming down to Vice President Kamala Harris's vote, the deciding vote. Nevertheless, the pushing of the $1.9 trillion stimulus package, having passed through stage 1 of the adoption process, something we commented upon in last week's videos, it certainly does look as if it will eventually pass. Now, in isolation, that may be manageable economically. But we're witnessing, not just in the US, but across the globe as a whole, a rapidly growing belief that for the world to get out of the recession that the COVID-19 pandemic has helped to cause, greater stimulus by all central banks and governments is necessary. And this is what Christine Lagarde said yesterday. Bloomberg article dated February the 6th, 11 p.m. GMT. Headline: ECB's Lagarde sees summer recovery. Tricky post-pandemic phase. European Central Bank President Christine Lagarde predicted the euro area recovery will pick up in the summer, while stressing that public authorities will have a difficult job weaning the economy off of emergency support. In an interview with French newspaper Le Journal du Dimanche, Lagarde expressed confidence in the region's ability to emerge from the coronavirus crisis stronger with a more digital and greener future. She also urged governments to speed up work on their spending plans so the European Commission can start issuing joint debt. We remain convinced that 2021 will be a recovery year, she said. The economic recovery has been delayed, but not derailed. People are obviously waiting impatiently for it. The ECB currently predicts an economic expansion of close to 4% this year, after a contraction of nearly 7% in 2020, and Lagarde said that that's still likely if support isn't ended too soon, though much depends on the rollout of vaccines. The European Union's vaccination programme has got off to a slow start so far, with only 3.6% of the population getting a dose. The UK has delivered more than 17 shots per 100 people, and the US is on almost 12. Resurgent infections have forced many euro area countries into renewed lockdowns, causing an economic contraction in the fourth quarter and making a double-dip recession practically inevitable. Output is running at about 12 billion euros or $14 billion a week, below pandemic levels, and the botched start to vaccinations means restrictions will only gradually be lifted. That makes the timely arrival of European Union recovery funds all the more urgent. Lagarde described the ECB's €1.85 trillion emergency bond buying programme as appropriate in size and reasonable in duration, promising policymakers will act for as long as the pandemic is causing a crisis situation in the euro area. But she also warned that once the pandemic is over and the immediate economic crisis is behind us, we'll have a tricky situation on our hands. We must not repeat the mistakes of the past by cutting off fiscal and monetary stimulus at once, she said. Instead, authorities must offer flexible support that is reduced gradually. Economies will then have to learn how to function again without the help of any of the exceptional measures that had to be introduced as a result of the crisis, she said. I'm not worried about this because the capacity for recovery is strong. Now, we fully accept that the European community is beset with its own problems and issues. But the pandemic has affected most economies in a similar manner. Massive business closures, rising unemployment, and diminishing, if not negative, GDP growth. With the advent of former US Federal Reserve Bank Chairman Janet Yellen becoming Biden's Treasury Secretary, we all knew that she would be quite dovish in approach to reflating the economy and would wish to spend more than many Republicans certainly would like, even though under their president, President Trump, the US national debt rose to an eye-watering $27 trillion. However, Yellen's comments, which have been published in a Bloomberg article today, appears to paint an interesting picture, almost an acceptance on her part that Americans should spend whatever it takes, and the more spent early on, the quicker the recovery would occur. Let's take a look at this. It's a very short article. Bloomberg article dated 7th of February 2021, 2:37 p.m. GMT. Headline: Yellen says US shouldn't settle for long, slow recovery. Treasury Secretary Janet Yellen said the United States can return to full employment in 2022 if it enacts a robust enough coronavirus stimulus package, but otherwise risks a much slower rebound in jobs and the economy. Quote, "We need a big package, and we need to get this done quickly," unquote, Yellen said Sunday on CNN's State of the Union. Without adequate support, it could take until 2025 for the US labour market to recover, Yellen said. There's no reason why we should suffer a long, slow recovery, she said. Separately, on CBC's Face the Nation, Yellen said the job market is in a deep hole. While President Joe Biden's $1.9 trillion stimulus plan is not specifically aimed at job creation, the spending it will generate will create demand for workers, she said. Yellen acknowledged that some have warned of inflation risks from Biden's plan, in which is moving ahead in Congress without support from Republicans. But the worries about inflation voiced recently by former Treasury Secretary Larry Summers was small compared to the scarring of economy, particularly minorities, low-wage earners and women, by not spending enough now on economic stimulus. Quote, "That's a risk that we have to consider. I've spent many years studying inflation," unquote, the former Federal Reserve Chair said on CNN. "I can tell you we have the tools to deal with that risk if it happens. As Treasury Secretary, I have to worry about all of the risks to the economy," Yellen said. End of article. You see, since Biden became president and Janet Yellen was mooted for the job as Treasury Secretary, we've stated quite categorically that we were heading, at least for some version, even if it's only a limited version, of MMT, Modern Monetary Theory, about which we've produced a series of videos. You see, what is occurring is not just restricted to one nation, country or set of countries, but to continents, with particular emphasis to those in the West. This, admittedly, is now once again the kicking of the proverbial can further down the road, And we suspect that if the economic figures are not as beneficial as anticipated as a result of this spending, then even looser monetary policy and more stimulus or packages introduced will be adopted, and then any future inflation dealt with later on. Now, naturally, many economists will argue that the consequence of this is going to be that currencies devalue and gold and silver prices will rise in value as a result of the currency devaluation. However, we also have to bear in mind if other nations are adopting similar strategies, then much then depends upon proportionality and which nations stimulate more or less with regard to each other. Now that said, regardless of what they do, whichever comes out on top or on bottom, it will serve to reduce the purchasing power of every currency engaging in this activity. And as we've shown previously, in the case of gold, somewhere between 80 and 90% of the time, and in the case of silver, the majority of the time, but not as high as gold, maintaining purchasing power parity. In other words, in currency terms, their value will rise, or their price will rise. Now, this is the key reason we're confident that precious metals will benefit this decade. We're expecting some form of economic reset towards the end of the decade, and we'll cover future videos on this subject. We've got a little time. And we're also expecting to see a conversion to either an entirely crypto, blockchain, cashless society, or a large proportion being linked in that way. But before then, we can see precious metal prices benefiting in value or price as currency depreciation occurs, even if there is parity across the board. Just a caution, we're not expecting dollar devaluation to happen overnight in an Armageddon instant collapse that our friends the pumpers will have you believe, but like snow, it will drift in over a period of time, and one has to ensure that one is prepared for that eventuality. The writing is undoubtedly on the wall for our currency values. It's just a matter of time, and the continual downward grind of purchasing power, accelerated in the last decade because of the 2008-9 crisis, is going to accelerate in this decade because of the COVID-19 crisis, and we are witnessing this now in real time. What are your thoughts? Do you agree? Disagree? Do you think it's going to happen overnight? Will gold and silver prices rise as a result of this? Or will the economies of the world pick up so substantially that equity markets will be the key beneficiaries, at least short to medium term? Do share your views. Meanwhile, thank you so much for listening, and if you haven't already done so, please subscribe to our channel. Not forgetting to press the bell sign so you're notified of our videos as and when they're published. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.